Equity markets have had a difficult start to 2016, falling approximately 7% year to date, centred on renewed concerns regarding China and the global economy. Disappointing Chinese PMI data in the first week of January, sharp falls in the Chinese equity market, and a weakening of the Chinese currency against the US dollar have reignited fears over the growth outlook and possible contagion elsewhere. The continued fall in the oil price has also raised concerns over the strength of global demand and risks of lower inflation. Chinese equity markets have fallen approximately 20% year to date. The decline has been partly due to fears of potential sales by large shareholders following the removal of trading bans and the impact of poorly designed circuit breakers which have now been removed. The Chinese equity market, however, is not correlated with the domestic economy in the same way as other markets are, as highlighted by the 200% plus gains in the market from mid-2014 at a time when Chinese growth was slowing. With few people directly owning shares, the wealth impact of stock market movements is much less than in other economies. And in the same way that consumer spending did not benefit from market gains in 2014, it should not be impacted by the recent decline in the equity market. Most of the economic releases in China through December showed continued signs of stabilisation, with retail sales rising to 11.2% year-on-year and industrial production improving to 6.2% year-on-year. In early January, however, both the KICS and manufacturing and services PMIs declined, sparking new fears about the Chinese economy. The services PMI, however, remains in expansionary territory above 50, while the manufacturing PMI is above the lows of August last year. Trade and lending data this week, however, were firm, which suggests growth remains underpinned. We believe more reliable indicators suggest the Chinese economy is still growing at a relatively strong level of between 5 and 6%. And while less than official estimates of 7%, the economy is not experiencing a hard landing or slowing to the extent discounted by recent global equity moves. With regards to the currency, we believe a sudden sharp decline of the renminbi against the US dollar, which could give rise to dislocations in financial markets, is unlikely. The Chinese authorities recently indicated the currency is now being pegged against a weighted basket of its trading partners, rather than the US dollar alone. This makes sense, as China's competitive position has deteriorated against its main trading partners given the strength of the US dollar. While the renminbi has depreciated against the US dollar by approximately 2.5% year to date, it has been relatively stable on a trade-weighted basis. With China indicating its intention is to maintain a stable currency on a trade-weighted basis, this implies some further modest but slow depreciation against the US dollar is possible, and a sudden sharp fall will be avoided. The continuation of global growth in the 2.5% to 3% range of recent years should support global equity markets, and it is important that a slowdown to 2% or less is avoided. Leading growth indicators, such as the PMIs, suggest the global economy will grow 2.7% in 2016. In developed markets such as the US and the UK, labour and housing markets remain strong, with US non-farm payrolls rising 292,000 in the most recent monthly release. Consumer confidence levels remain high, and with the reduction of fiscal drags in many economies in 2016, the boost to consumer spending power from weaker oil prices, and positive bank lending growth of over 2.5% in the global economy is expected this year. On a valuation basis, global equities are now offering value again, trading on a price-to-earnings multiple of 14.8 times, below the long-term average of about 15.5 times. Equities remain extremely attractive relative to cash and bonds, offering a dividend yield of 2.6% compared to deposit rates close to zero, and 10-year sovereign bond yields in Germany and Ireland of 0.5% and 1% respectively. Global monetary policy remains accommodative, And while the ECB disappointed in December in terms of the level of additional stimulus announced, the downside risks to inflation should result in further measures being announced in coming months, while pressure on the Bank of Japan to announce additional measures is also increasing. While the US Fed raised rates for the first time in this cycle in December, recent developments and inflation trends should result in the pace of tightening being very gradual, so that monetary policy in the US also remains relatively accommodative. Greater comfort on the part of investors with regards to the economic backdrop is required for equity markets to begin to stabilise and recover the losses experienced in the first few weeks of this year. But we believe this will be forthcoming. Volatility in markets, however, is likely to remain a feature, both in the short term and over the course of the year, as various uncertainties overhang markets. Nevertheless, over the course of 2016, we expect the positives to outweigh the negatives, and for equities to generate positive returns of mid-single digits for the year as a whole, or double-digit returns from current levels.